back to the KJ Methods YouTube channel. Don't forget to like, subscribe, and share this video with all who may be trying to pass their real estate exam. What I've decided to do today is a finance practice exam. So let's get started. Question number 1. Which clause in a mortgage would prevent the borrower from allowing another person to assume a loan without paying it in full? I'll give you a couple of seconds on that one. Here are your answer choices. Okay, so the answer here would be alienation clause. An alienation clause. An alienation clause, what does that word alienate mean? It means to transfer, right? To transfer property from one person to another. Well, if you remember, the bank can prevent you from allowing someone to take your loan over by just including an alienation clause. What they're essentially saying, if they include an alienation clause, is we do not want you to allow anyone to assume a loan. So that's just pure definition. That's what you're looking for. Question number 2. Absent an FHA loan, a lender may require a buyer with lesser credit to have a... There are your 4 answer choices: lower credit score, lower down payment, higher down payment, higher loan to value ratio. What do you guys think it is? Okay, the answer here would be a higher down payment. Now let's think about this for a second. It says absent FHA. Absent FHA. That means that the bank is not going to be regulated by the normal FHA provisions. And so they're saying, whoa, this person has shaky credit. What can we do? Lower credit score? No. Lower down payment? No. The bank wants to be in a better position, not in a worse position. Don't forget, the lower your down payment, the higher the bank has to give you, the higher the LTV, right? And so they're going to require that you have more skin in the game, right? A higher down payment. And then D, higher loan to value ratio. No, that's the same thing as saying a lower down payment. And so no, they would require you to have more money into it so you have more to lose. Question number 3. When referring to loans, the principal is also the amount borrowed or outstanding, the one who hires an agent to perform, the lender, or the beneficiary. So when you hear the term principal, when you're referring to loans, what do you think of? Well, I think that you should be able to pick this one out relatively quickly. The principal would be the amount you borrowed or outstanding. Right? If you remember, you're going to go to the bank. You are going to borrow a certain amount of money from the bank. You're going to put in a certain amount of money. The amount you borrow from the bank is called the principal. And I say the amount that's left outstanding, right? Because you may be paying that principal down. That's the whole goal before that loan is entirely paid off and you can say you own the house. Question number 4. Which situation would not trigger the acceleration clause in a loan document? Let's look at our answer choices. The borrower fails to pay the escrow portion on his home loan, but sends the mortgage portion into the bank. In other words, you have a payment, including escrow. You only send in the mortgage portion, which is the principal and interest. You don't send in the escrow, right? Your payment is short. The borrower fails to pay his PMI insurance. If you remember, you got that private mortgage insurance sometime, you failed to pay it. The borrower misses 5 payments on his automobile loan and then the borrower defaults on the mortgage. You don't pay the mortgage. So which one do you think would trigger the acceleration clause in the loan document? Well, hopefully you were able to pick this one out relatively quickly also. That would be the borrower misses 5 payments on his automobile loan. Why is that? Look at A, B, and D. They are all related to the house itself, right? The loan on the house, the escrows on the house, the PMI on the house. And so the acceleration clause is the clause that says if you default on any of these things, then the bank can call the entire loan due. But if you miss 5 payments on your vehicle, that has nothing to do with the loan. Now, that's not to say that later on that's not going to be a problem, but it does not immediately trigger the acceleration clause in the loan documents. All right, question number 5. Let's see. One disadvantage of an adjustable rate mortgage is, let's look at the answers. The payments are lower at the beginning of the loan. You cannot determine when the payment will change in the future. You cannot determine what the payment will be in the future. You cannot determine what the new escrow amounts will be in the future. An adjustable rate mortgage. Which one is that? It's the mortgage that the rate on the mortgage adjusts. It could go up or down depending upon what index we're looking at. You guys remember that one? All right, so it adjusts up or down. So let's look at A. The payments are lower at the beginning of the loan, right? The answer to this one is going to be C. That is true because generally with an adjustable rate mortgage, the interest rate is lower at the beginning. And so your payments are going to be lower. Let's look at B. You cannot determine when the payment will change. Well, that's not true at all because you are able to know when they will change. But as we just said on C, you are not going to know what the payment will be in the future. And that is a disadvantage of an adjustable rate. And why is that? Because we have to look at the index. The index is going to tell us what the payment is going to be in the future because it's going to tell us what the interest rate is going to be. And our payment is going to adjust based upon that interest rate. Let's look at D. You can't determine what the new escrow amounts will be. That's true. But that's not just an adjustable rate, right? Taxes and insurance, we never know what they're going to be. And so that is not strictly an adjustable rate mortgage. Any mortgage, we don't know what those escrows are going to be. So again, there it is C. Question number 6. John is behind on his mortgage loan of $250,000 and he wants to sell his property, but it is only worth $200,000. He also has 2 judgments against the property that were placed on it after the mortgage. His best option would be, let's look at it. A, judicial foreclosure. B, non-judicial foreclosure. C, deed in lieu of foreclosure. And D, short sale. Which one do you guys think it is? Okay, on this one, it is going to be a short sale. But let's talk about it. You probably should have gotten rid of judicial foreclosure and non-judicial foreclosure pretty quickly because, first of all, the borrower has nothing to do with whether or not it's going to be a judicial foreclosure or non-judicial foreclosure. It depends on what state you're in. If you remember, we have judicial foreclosure states and non-judicial foreclosure states. So that has nothing to do with the borrower. You don't get a chance to pick. But how about a deed in lieu versus a short sale? Why is the answer short sale, not deed in lieu? If you remember, a deed in lieu is you're basically saying, hey, I can't pay this thing. I can't pay it. Can you take it back? With the short sale, what you're saying is you're going to go to the bank and say, hey, I cannot sell it for $250. I can't get the money for the $250. would you allow me to sell it for less? Would you allow me to sell it for less? And so why here is it short sale versus deed in lieu? Because the question also tells us that he has two judgments against this property. Now, here's the problem with a deed in lieu. A deed in lieu is a good avenue, but the problem with it is that if that bank takes that property back under a deed in lieu, those judgments do not get extinguished at all. So the bank is going to take that property back subject to those two judgments on the property. In a short sale, we can actually pay those judgments off at closing. Make sense? Okay, so short sale would be more appropriate in this situation. All right, let's look at question number 7. Which of the following statements about FHA loans is true? Let's see what we have. There is no maximum loan amount required by law. The loan-to-value ratios are lower than conventional loans. FHA will pay for insurance protection for the borrower in case of default, and the loan will be based on the appraised amount or the sales price, whichever is lower. Which one do you think it is? Okay, the answer here is going to be D. The loan will be based on the appraised amount or the sales price, whichever is lower. So let's look at A through C. There is no maximum amount. There definitely is a maximum loan amount as required by law under FHA. It is highly dependent upon where the home is located. B, the loan-to-value ratios are lower than conventional loans. No, they're higher. The bank on an FHA loan is going to give you what? Maximum amount of 96.5%. The borrower is only going to have to come up with 3.5%. The bank is really not preferring that type of loan, right? That's why we have it as an FHA insured loan. Normally, the bank would like you to come up with more, and so it would be a lower loan-to-value ratio. So FHA has a pretty high loan-to-value ratio. The next one, FHA will pay for the insurance protection for the borrower. No, they won't. They will insure this loan, but who's paying for it? The borrower. And so the last one, of course, when we look at a sales price or the appraised amount, we start at whichever one is lower, and then the bank will base the loan on that amount. So D is correct. Let's look at question 8. The seller is seeking to allow a buyer to assume his existing loan, but is looking for the greatest protection against liability because the seller is moving to another state and buying another home there. How should this seller proceed? Let's look at our answers. The seller should request that the bank allow him to assign the contract to another person. The seller should request that the bank allow him to novate the contract. The bank should issue a mortgage satisfaction or request that the bank issue a cancellation of debt. Which one do you think on this one? All right, the correct answer on this one would be that the seller should request that the bank novate the contract. Let's look at each of these. A, assigning the contract. It's actually called an assumption in loans, but in any event, if you remember from an assignment or an assumption, do you get relieved of liability? No, you do not get relieved of liability until the other person performs. And so A would definitively be wrong. Let's look at C. Request that the bank issue a mortgage satisfaction. That sounds decent, right? But that is only when the loan is paid in full and you are in a lien theory state. Then the bank will issue a mortgage satisfaction. Request that the bank issue a cancellation of debt. Same thing here. They're not going to cancel the debt until it's paid off in a title theory state. Understand that under an assumption, we're not paying the loan off. We're essentially transferring that loan to someone else. And so the best answer here would be that you ask for the bank to novate the contract, because what a novation does is release the person who is performing the sale, the seller, from liability. It's a substitution of parties. You're essentially saying, I'm not going to look to you anymore, seller. I'm only going to look to this new buyer. All right, question number 9. Let's see what we have. A lending institution blanketly refuses to make loans in a specific neighborhood in the city due to presence of minorities there. The lender has committed a violation of the Equal Credit Opportunity Law, the Fair Housing Law redlining provision, the Fair Housing Law blockbusting provision, the Federal Housing Authority's 203B provision. Which one do you think that it is? Should be able to pick this one out pretty quickly because it really is vocabulary, even though it's scenario based. It would be the redlining provision. Redlining, if you remember, is done by a lender, and what the lender is saying is, we're not going to that neighborhood and we are not going to that zip code, and it is a violation of the Fair Housing Law. Let's look at the other ones. Equal credit opportunity is when the lender refuses to make loans to certain people. It's generally the fair housing categories, but we do add age and public assistance there. And blockbusting is generally done by an agent when you're doing, marketing in some form or fashion of saying that minorities are going to be moving in. And 203B provision, FHA, the most common FHA loan is a 203B loan. And so that's all that that's saying there. Last one, question 10. Let's see. When a government determines that there is a need to slow the economy, what is the most likely result? Let's see what we have. Interest rates will increase. The discount rate will decrease. Housing prices will increase. Loan costs overall will decrease. What do you guys think? We're trying to slow the economy. All right, most likely they're going to increase interest rates. Let's just talk about that quickly. What happens when interest rates increase? People are starting to go, oh my goodness, I'm not going to be able to afford that because the interest rates are going up. And so what it's going to happen is it's going to constrict the economy, right? They're trying to slow it. So if they raise it, people are going to buy less. But let's look at B. The discount rate will decrease. Well, what is the discount rate? If you remember, the discount rate is the rate that the Fed charges to member banks, right? But let's think about it. If they decrease that rate, that means interest rates are going to go down, not up, all right? And so that would be incorrect. Housing prices will increase. Well, if the interest rates are higher, housing prices should, over time, begin to reduce, but that is also not like directly government intervention. So they can't do that at the inception. What they can do is deal with the interest rates and then hopefully put pressure on the economy. And then the last one, loan costs overall will decrease. No, loan costs overall will increase because, again, that interest rate going up, that means over the life of the loan, that loan is going to be more expensive. Okay, guys, so that's it for today. Hopefully that was helpful to you. Don't forget to like, subscribe, and share these videos. Thank you so much for coming to the KJ Methods YouTube channel. I'll see you next time.